Welcome back to your legends. I'm Dr. Khan. Let's get right into this video. The stock market today is up on all three major indices. The S&P is up 2.6%, the Nasdaq 2.27%, and the Dow leading for the first time in forever, up 2.66%. Let's take a look at the different sectors, and this is why the Dow is leading. It's because of energy, it's because of basic materials. And why are energy and basic materials rallying like there's no tomorrow? Well, it's because of this, guys. This is the dollar index. And if you remember, guys, I pointed out this prior support line, which acted as resistance twice, 3 times. Once we broke through it, it acted as support. And now we're breaking through it again, forming this false break top in the dollar. Now, I don't think that this is the top in the dollar, but a top for now. We also had the 10-year yield break down the 9-day EMA for the first time in a very, very long time. And the stock market loved that. Gold absolutely loved that. And energy stocks, basic materials absolutely loved that. Now let's take a look at the stock market map and just look at this. Rallies all over the place. Green, green, green everywhere except for Tesla. One of my stocks that I shorted last week. I mean, what are the odds? Look at this. Everything is green except for Tesla, Tesla, Tesla. I even have all of my drawings from the last video up. So where does this sell-off for Tesla stop? Well, we're now entering a very, very active area where a lot of trading took place. So Tesla can find some support here. But this bearish structure where we had a triple top right here with significant bearish divergence, the full measured move on this structure will take us down. Look at this. This is the full measured move right here to $225. Would I be shorting Tesla here? No, I shorted Tesla here and I took profits here, expecting that bounce in the S&P 500. And because I wanted to take some risk off the table going into a binary event like the AI day. And just as we suspected, guys, as soon as we took these lows out, we had that waterfall sell-off that I talked about in Tesla. Now, I did short here and I did take profits here, anticipating one move to the upside before more shorting comes, because I was anticipating this move to the upside in the S&P. But the AI day was so bad that we ended up just absolutely collapsing here. And so there might be a good buying opportunity for Tesla when we get down to 225. I would say, yeah, I'll be looking back at Tesla for some buying here, assuming we build some bullish structure. Now let's start with the S&P 500, everybody. And just look at that. Just as we expected today, we had a massive, massive, massive bear trap slaughtering all of those bears that got in last week. We warned twice. We warned twice last week. Don't short into the hole. The market will trap you and the market will punish you. Now, admittedly, I expected something more like this. A doji candle with an open down below Friday's close, something that looks more like this, because that would have allowed the bears to exit with their accounts and egos intact. But the market said, no, screw you bears, we're going to absolutely punish you. And that's what happened today. Now, we also had a very significant break to the upside today. We finally broke this resistance line for the first time since that 125-day rejection and pretty much since the beginning of this September crash. And what do you know? What did we say following Friday's close? Stock market crash ending, the September crash is ending, and a bottom is forming. And sadly, a lot of people just did not want to listen to the technicals. So many retail traders went into this week being extremely bearish. I mean, look at this, 60.8, just 0.1% away from the record just a week prior to that. Everybody was super, super, super bearish, and we warned, look at this. This is the put to call ratio. We warned the put to call ratio was forming an ascending wedge that was waiting to break. And in fact, it did break Friday. This chart hasn't updated just yet. It takes a little while to update, so I will update everybody when we get the latest reading. But following today, there's no doubt that we took out this support line in this ascending wedge. And that always, guys, always triggers buying. We crossed below 1.1 the last time that happened. We had a rally. The prior time that happened, we had a rally. And even the prior time that happened without a crossover on the PPO, we still had a rally. This was very, very sneaky by the market, because if you look at the weekly chart, we had this water drop looking candle, a bearish candle that usually results to a gap down the next day. And we had that. We had that in the pre-market. The stock market actually did gap down in the pre-market. And if we put up the futures market here, we actually did end up gapping on the day and on the week. We opened below Friday's close. The bullish momentum was very strong today, and we ended up filling that gap really before the market opened. So we did end up having that gap. It just occurred in the pre-market, in the futures trading. Now, unfortunately, these kinds of bottoms, I do not trust these kinds of bottoms where we fill the gap in the pre-market. These bottoms tend to correspond with very sharp and strong bear market rallies, but not sustainable long-term trends like the bottom that we had back here. So as of right now, I do anticipate that this is the bottom that we've been waiting for that counter trend rally going into mid-October before the next leg of selling comes back. Now, the market does not go down a straight line, and we always have these strong, really rip your face off bear market rallies, and I suspect we will see that this week and possibly into next week. But be warned everybody, next week on October 12th, we will have the CPI, the PPI, the Producer Price Index, and the FOMC minutes, and the day after we'll have the CPI. So October 12th, two major events, PPI and FOMC minutes. October 13th, another major event, the core inflation and inflation rate, the CPI. Now, the close of today was also very interesting. Now, with all of that being said, there are a couple of interesting things that I do want to point out. The first is we rallied on very low volume. Again, very indicative of a bear market rally. Number two, we closed back within this prior demand zone, now a supply zone. What we need to see is more strong volume, higher buying volume, and a close above $370. And at that point, I suspect that it will be more likely for the market to rally up to 380. And at that level, we will be running into a bunch of really critical economic events on October 12th and October 13th. And at that point, I will be more inclined to believe that the risk is way greater to the downside than it is to the upside. So sadly, yeah, we did get that bear trap and slaughter that we were expecting, but it was way worse for the bears because we did not get that gap down for them to be able to close their positions and exit. We just had this rip from the get-go. And so we have so many bears trapped at these levels now. And the more we rally, the more they will have to cover their shorts, fueling a very powerful short squeeze rally. This resistance line will now switch to being a support line. So even if we sell back down, we will find support here at this resistance line, now a support line. Let's take a look at the HYG. And again, this divergence I pointed out twice on Friday's video and again on the weekly update video. And we had this very obvious, clear and beautiful bullish divergence where the HYG, the smart money, the high yield bonds were putting in higher lows as the S&P was putting in lower lows. The last time this happened, we had the June low right here. The prior time, we had the May low right here, where we made new lows on the S&P and higher lows on the HYG. So yes, this signal does work. It's not by any means a prophetic signal or like a gold standard or something like that, but it is a very important signal to look at, especially if you're looking to short. Don't short when there's a bullish divergence. Just don't do it. It's not worth it. Let's take a look at the VIX. And again, guys, another very obvious and bullish divergence I'm seeing here. Look at this. The VIX put in a high here and a lower high here. Boom. While the S&P put in a low here and a lower low here. Boom. Right? The VIX should be making new highs as the S&P is making new lows. That did not happen. That occurs at bottoms. Look at this. Double top, lower high, double bottom, lower low. Again, right here, guys, we had a double top, double bottom. We had a rally. Ended up forming into a triple top and a triple bottom. Same thing happened back here, even in December, guys. Double top, double bottom. These structures are very easy to spot. Just look at the charts. Let's take a look at the DXY, the dollar index. And again, we had that breakdown. Now I suspect the dollar will continue to see weakness, fueling more and more of that short squeeze rally, absolutely strangling, destroying those bears before switching and becoming a bull trap at the top here at the 380 level and trapping the bulls, the Johnny-come-lately bulls that will get their turn in the abattoir. Now, let's take a look at the 10-year yield. Again, look at this, guys. The 10-year yield broke down for the first time below the 9-day EMA, really since we put in that low back here in August. And we've just haven't seen that since we had this breakdown here. And look at that, it marked the June low, right? So a lot of bullish divergence have been building, and they're now being confirmed. Look at this, a bearish crossover on the 10-year yield, another bearish crossover. So a rally is due, guys. A big rally, a small rally, nobody knows, but a rally nonetheless. Do not short into the hole. Let's take a look at gold. Again, I pulled up this chart last Friday, and I did warn everybody, when we get a bullish crossover on gold, we tend to have nice rallies in the S&P. And what do you know? The exact same thing happened here. Bullish crossover, rally in gold, and a rally in the S&P. Now, the put to call ratio, everybody, again, this data has not been updated yet, but if I move to the CNN put to call ratio, we did make a new low today. We closed 3 points below Friday's close. Now, if I simply apply that 3-point decline, we will be down at 1.05, and we will have broken this ascending wedge pattern, a bearish pattern that breaks to the downside, allowing the stock market to rally. Now, let's quickly jump to the fear and greed and look at that at double bottom on the S&P market momentum with a lower low and a higher low on the PPO. Even the 2-hour chart on the PPO, look at this, guys. We've been making higher lows. We had this near crossover here on Friday. We did not get that crossover, and so we did not end up with that dump. We just continued to rally. Again, this warns me that this is a sharp and strong bear market rally, not the kind of bottom that I would like to see, where there's more structure, where both longs and shorts can exit safely. This is something else. This is a very sharp, in-your-face gap and rip to the upside. Again, stock price strength is now flattening. Breadth is now flattening. Put to call ratio broke below the ascending wedge. Market volatility, double top and moving down. Safe haven demand is now switching back to being more leaning towards the stock market outperforming bonds. And junk bond demand is now moving up. The yield spread between investment grade and junk bonds is now declining. Again, a bullish sign. So there you have it, folks. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.